As investors, one of the main reasons you should build up your emergency cash reserves is because it will give you the security to invest in the stock market and ultimately enable you to meet unexpected expenses without selling your equities when they're down. With a sufficiently big emergency fund in place, you'll find it easier to develop the confidence to stick to long-term investing. So in this video, we'll explore several options for your emergency fund. We have a lot of options to go through, which I will rank using a tier list based on the following factors. Accessibility, meaning how easily and quickly you can access the funds in an emergency. Interest rates, whether the option helps your money keep pace with inflation, preserving its value over time, and any minimum balance needed to open or maintain the account without incurring fees. Before we explore each option, please remember that I am not a financial advisor and this video is not a recommendation. First of all, we have the most obvious option, easy access savings accounts. With these accounts, you deposit cash, earn interest, usually either monthly or annually, and can withdraw your money whenever you need, which makes them perfect for emergencies. However, some accounts may limit the number of withdrawals you can make each month or year, and exceeding that limit could lead to reduced interest, so it's worth checking the terms when choosing an account. Looking at the latest data from moneysavingexpert.com, easy access accounts offer competitive rates. You could earn up to 5.2%, which is excellent for cash savings, but this specific account requires a minimum deposit of £5,000. Other higher rate options might have even higher minimums, like £25,000. So this is something to bear in mind. Each account comes with specific conditions, such as minimum deposit requirements and withdrawal limits. Of course, there are also accounts from well-known providers that offer lower rates but have more relaxed criteria. Now, one downside is that interest rates on easy access accounts are variable, but if your rate drops, you can always move your money to a better paying account. So given their easy access, competitive interest rates, which should help our emergency fund keep pace with inflation, at least theoretically, and relatively low minimum deposit requirements, depending on the account, I would place this in the S tier. If you'd rather have a guaranteed higher interest rate, you may need to sacrifice the flexibility that comes with an easy access account and lock cash away in a fixed rate account. With a fixed rate account, the interest rate is set for a specific time period, which guarantees your return. However, you can't usually access the cash during that time, and even if you can, the penalties can be quite large. Since we need immediate access to our money in case of an emergency, a fixed rate account might not be the best choice for our emergency fund. And the same applies to notice accounts. You will have to wait a little to access your cash, typically 30, 60 or 90 days. But in exchange, you may earn a better interest rate compared to easy access accounts. But as with the fixed rate accounts, given that we can't access our money immediately, they may not be the best place for an emergency fund. Therefore, I would place both of these in the B tier. Next up, we have regular savings accounts. These accounts are less flexible than easy access accounts and come with more restrictions. One common condition is that many of them require you to be an existing customer of the bank, although this isn't always the case. Typically, regular savings accounts also require you to make a minimum monthly deposit, impose limit on how much you can contribute each month, and tend to limit the number of withdrawals you can make. Of course, the details can vary depending on the specific account and bank, but it's something to consider because once you've built your emergency fund, you might prefer not to keep making monthly deposits. The good news is that as you don't have as much flexibility, regular savings accounts tend to offer higher rates than what you earn on an easy access savings account. For example, they can earn you as much as 7%. The rate also tends to be fixed for usually a year, giving you certainty on the interest you earn. So taking all these factors into account, I would place this in the A tier. Before we move on to the next option, it's worth saying that with all of these accounts, interest is technically taxable. But due to the personal savings allowance, most savers won't pay tax on the interest they earn. Next up, we have cash ISAs. A cash ISA is just a savings account where you'll never pay tax on the interest. And currently, you can contribute up to £20,000 per year in one or more cash ISAs. Just like normal savings, cash ISAs come in different types. There are easy access ISAs, which allow you to withdraw your money whenever you want, and fixed rate ISAs, which offer a guaranteed interest rate but require you to lock your money away for a set period. Considering that you need a significant amount saved before you start paying tax on your interest due to the personal savings allowance, I believe that regular savings accounts might be better suited for an emergency fund compared to cash ISAs. This is because you might prefer to use your annual ISA allowance for stocks and shares ISAs, particularly if you're able to invest the full £20,000 allowance. Starting with easy access cash ISAs, they tend to be quite competitive and offer very attractive rates, as you can see here from the latest money saving expert data. They have low minimum deposit requirements and are easily accessible, which is ideal for an emergency fund. However, keep in mind that, as with easy savings accounts, rates on these accounts are variable. It's worth saying that although easy access cash ISAs let you take out your money when you want, there are some important things to note about them which differ from standard savings accounts. First of all, only some cash ISAs are flexible, meaning you can replace cash withdrawn from them in the same tax year into the same cash ISA without using up your year's ISA limit. If a cash ISA isn't flexible, all deposits count towards your ISA allowance, regardless of any withdrawals. Secondly, if your existing cash ISA is earning a lower rate and you're looking to transfer to an account that pays a better one, you may be able to do so, but it works differently to switching a standard savings account. For instance, if you want to transfer, you should never withdraw money from a cash ISA because you lose all tax benefits if you do. Instead, speak to the new provider and fill in an ISA transfer form. They will then move the money over for you, keeping your ISA cash tax-free. So I would place this in the A tier because while they offer easy access and competitive rates that will help your money keep up with inflation, the fact that they will reduce your annual ISA allowance is a big downside. Moving on, we also have fixed rate cash ISAs. Similar to regular fixed rate savings accounts, these accounts are meant to lock your money away for a set period in exchange for a guaranteed interest rate, which can currently reach up to 4.6% according to moneysavingexpert.com. However, by law, fixed rate cash ISA providers must allow you to access your money. Some providers may require you to close the account or transfer your funds to access them, and many impose significant penalties for early withdrawals, ranging from 60 to 365 days worth of interest. In my opinion, these accounts are not ideal for storing your emergency fund. As with fixed rate savings accounts, I would place these in the B tier. Okay, before we continue, make sure to hit the subscribe button if you're getting any value from this video. Thank you. Moving on, the next option is the NSNI route. NSNI stands for National Savings and Investments. They offer all kinds of products, including income bonds, the popular premium bonds, a direct ISA, which is basically a cash ISA, a direct saver account, and more. One of the biggest attractions of NSNI is that what you save, regardless of size, is fully protected by the Treasury. Now remember, what we're looking for here is a product that gives us easy access to our emergency fund, as well as earns us some good interest to keep up with or potentially outpace inflation. So if you opt for a savings product with NSNI, the easy access options are the direct saver and income bonds, which both currently pay 4%, and the direct cash ISA at 3%. Let's quickly look at each of them, starting with the direct saver. The direct saver option is quite solid. As you can see here, it offers a 4% interest rate, although it's variable and can go up or down based on changes in the Bank of England base rate or shifts in the general savings market. One of the advantages of this account is the low minimum deposit requirement and the fact that it provides instant access to your money. In my opinion, this makes it a great option for storing an emergency fund, so I would place this in the A tier. Next, we have income bonds, which are also an attractive option. Currently, they offer rates similar to the direct saver, and like the direct saver, these rates are variable. They allow you to invest a lump sum and do not need to make regular monthly deposits. You can then add more money to your income bonds at any time, but it's not mandatory to do so. A key difference is that the minimum deposit for income bonds is higher than for the direct saver, which may be a consideration depending on the size of your emergency fund. Importantly, income bonds allow you to access your money with no notice period, making them well suited for an emergency fund. So given the easy accessibility, flexibility, and competitive rates, I would place income bonds in the A tier. Next, we have the direct cash ISA. I will keep this brief as many of the principles discussed for the regular cash ISAs apply here as well. This ISA offers a lower interest rate of 3%, which is less competitive compared to the other cash ISAs on the market. While it has low minimum deposit requirements, it might not be the best choice for an emergency fund, particularly if you prefer to use your £20,000 ISA allowance for a stocks and shares ISA. Therefore, I would place this in the B tier. Now, we also have to talk about premium bonds. These are incredibly popular because savers stand an outside chance of winning a life-changing sum of money as part of the bargain. However, the odds are stacked dramatically against you, and this comes at a cost. These bonds don't pay any interest. So without above average luck, your savings will be losing spending power when you take inflation into account. Of course, the larger your pot, the higher the chance of winning, as it's more likely NSNI will pick your bond number. In terms of access, you can request to withdraw your money at any time. There is no notice period required. The minimum deposit required is also low, but it doesn't justify putting your emergency fund in them, in my opinion, given that you earn zero interest. Therefore, for me, this option goes in the D tier. Moving on, I thought I would talk about bond funds because some people consider using bond funds for their emergency savings, specifically those managed by investment firms like Vanguard, rather than those offered by high street banks. The thing with bonds is that they are treated as a safe, low-risk investment. But the reality is that they can still lose value and the reward is probably not worth it. For example, this is a popular Vanguard bond fund that's globally diversified. But looking at its past performance, it's actually lost money over a 5-year period. And over a 10-year time frame, it's only grown 1.16%. Although bond funds are relatively conservative, they are still subject to market fluctuations. Additionally, accessing your money would involve selling the bonds, waiting for the transaction to settle, and then transferring the funds to a bank account for immediate access. This means that they may not be an ideal place for an emergency fund. Remember, your emergency fund is meant to be a safety net, not an investment. It should be kept in a zero-risk vehicle. Therefore, I would place bond funds in the C tier. Okay, lastly, we have another popular but more sensible option: money market funds. A money market fund is a low-risk investment that gives you a place to hold rather than grow your savings, while aiming to give you a slightly higher return than cash. Instead of investing in bonds or shares like most funds, it invests in short-term debt. This then pays a small return as interest. However, despite their low-risk profile, money market funds are still investments, and there is a chance that the value of your investment could decline. While the risk is somewhat mitigated by extensive regulation, it's important to note that, similar to bond funds, money market funds may not be ideal for immediate cash access, because in order to access the money, you'd have to sell and wait for the transaction to settle and so on. In terms of interest rates, the main thing worth pointing out is that they will typically track the base rate, technically the SONIA rate as it's called. So they will always give similar returns to savings. So I don't think there is a huge argument for choosing them instead of savings accounts. Therefore, given all these factors, I would place them in the B tier. Okay, I hope you found this comparison useful. If you did, please give a thumbs up and consider subscribing if you haven't already. Also, make sure to check out this video to learn why I've reconsidered the idea of retiring early based on some interesting data from Vanguard. See you there.